In a world driven by instant gratification, understanding the simple concept of compound interest can tremendously shift your financial trajectory. Imagine a snowball rolling down a hill. As it rolls, it collects more snow, growing larger and larger. This metaphor encapsulates the essence of compound interest. But what exactly is compound interest, and why is it so crucial? Compound interest is interest calculated on the initial principal, which also includes all the accumulated interest from previous periods on a loan or deposit. Essentially, you earn interest on your interest. This is what makes it so powerful, especially over time. To comprehend this, consider a very simple example. Let's say you invest $1,000 in an account that offers a 5% annual interest rate. After the first year, you will earn $50 in interest, leaving you with $1,050. In the second year, you earn 5% on $1,050, resulting in $52.50, bringing your total to $1,102.50. This cycle continues, and this is where the concept of compounding really takes off. Over decades, the impact becomes astonishing. A study by the investment management firm Vanguard revealed that if you start investing your money earlier, even small amounts can lead to significant wealth over time. The difference between investing for 10 years versus 30 years is monumental. For instance, if you invest $1,000 at 7% annually, in 30 years, you could have around $7,612, compounded from just the initial investment without additional deposits. This example highlights the urgency of starting early. But what about the impact of waiting? Consider John and Alex, two friends who both earn $50,000 a year. John starts investing $5,000 at age 25, while Alex waits until he's 35. By the time they both reach 65, John's investment could amass over $1 million, while Alex, despite investing the same amount, would only scrape by with roughly $500,000. This illustrates the exponential growth potential that compound interest offers and how crucial it is to begin as soon as possible. Additionally, it's important to note the time value of money. A dollar today is worth more than a dollar tomorrow due to its potential earning capacity. This is why financial experts often emphasize the importance of investing as early as possible. So, what's the takeaway here? The sooner you start, the more wealth you can accumulate through the magic of compounding. But what happens when we consider inflation? That's where the real secret lies, and it's something you don't want to miss out on. Compound interest isn't just a mathematical concept. It has played a pivotal role in shaping economies and individual fortunes throughout history. One of the most famous examples is Albert Einstein, who famously referred to compound interest as the eighth wonder of the world. He believed those who understand it earn it, while those who don't pay it. This principle was illustrated vividly by early investors in the stock market. In the late 1800s, one of the earliest wealth stories we can explore is that of Andrew Carnegie. Starting from humble beginnings, Carnegie utilized the power of compound interest and reinvestment strategies to accumulate a fortune that would ultimately allow him to become one of the wealthiest men of his time. He established Carnegie Steel, and through reinvesting profits, he was able to leverage compounding in ways that transformed not only his business but also the American economy. Another compelling case is that of Warren Buffett, who began investing at an incredibly young age. Buffett's net worth has skyrocketed, largely due to the concept of compounding. His investment strategy is based on the principle of holding stocks long-term, allowing the earnings to compound over time. We often hear stories of individuals who have built empires through the power of compound interest. But it's not just limited to the elite. Consider the story of a teacher who diligently saved a portion of her salary each month. By investing early in an index fund with a modest return, she watched her savings swell over the years, far exceeding her final salary upon retirement. It's clear that compound interest has forever altered the trajectory of countless lives. Yet, in discussing historical wealth accumulation, we must also address the concept of debt and its compound nature. Credit card debt, for example, compounds interest at alarming rates, which can have devastating effects if not managed properly. Consider two individuals, one saving and investing, the other accumulating debt. The latter can find the burden of debt crushing due to the compounding effect. The historical narrative demonstrates how compound interest can be a double-edged sword. It can either create vast wealth or lead to significant financial ruin. Why is this important? Understanding both sides of the spectrum can empower individuals to utilize compounding positively. But as we explore further, let's dive into strategies that can help mitigate the negative impacts and maximize the benefits of compounding. The narrative around compound interest centers significantly on the concept of time. Starting early can make an astonishing difference in the wealth you accumulate over your lifetime. But why does timing matter so much in personal finance? Let's take a closer look at this. Imagine you have two individuals, Emily and Jake. At age 20, Emily invests $2,000 annually into a retirement account, while Jake waits until he's 30 to start investing the same amount. By the time they reach 65, the differences in their retirement funds can be staggering. Emily's total could reach over $1 million, while Jake might only accumulate about $400,000. This example demonstrates just how critical those initial years are. Financial planners often emphasize that these first few years can be golden periods where even modest investments can grow into substantial amounts. The earlier you invest, the more years you have for your money to grow, making a case for why young adults should start saving as soon as they begin earning. Statistics reveal that people who start saving in their 20s will have significantly more than those who delay. According to a study by Fidelity, those who save just $1 a day in their 20s can end up with over $250,000 by retirement. That's the miracle of compounding. Yet, many young people don't realize their potential. Often, they believe they need to invest large sums of money to see real growth. The truth is, even small contributions can lead to massive results, thanks to compounded growth. One of the biggest misconceptions is thinking that investing is only for the wealthy. However, the power of compound interest clearly shows that starting at any financial level can result in significant wealth accumulation over time. Furthermore, the psychological aspects of delaying investments play a critical role. Many individuals fall into the trap of, "I'll start saving tomorrow." This can lead to missed opportunities as time slips away. The same Fidelity study emphasized that procrastination can cost thousands over the span of a lifetime. It's imperative to dispel the myths surrounding investing and to encourage early financial education. The conversations around money, saving, and investing need to start long before a person reaches retirement age. Realizing that investing isn't just a rich person's game but an opportunity for everyone can empower the next generation to take charge of their financial futures. As we dive deeper, explore with us the intricate ways to maximize those early investments as we reveal strategies that could alter your financial journey. Stories resonate more than statistics, and when it comes to compound interest, the real-life success stories can be the most inspiring. Let's delve into the impactful narratives of individuals who took advantage of compounding to build wealth. One notable example is that of Sarah Blakely, the founder of Spanx. Starting with just $5,000 and an idea, Blakely focused on reinvesting her profits back into her company. Over the years, she watched her initial investment multiply exponentially. Today, her net worth is over $1 billion, testament to the power of compounded growth and reinvestment. Another fascinating case is that of Robert Kiyosaki, the author of Rich Dad Poor Dad. Kiyosaki teaches the importance of investing and leveraging compound interest. Through real estate and financial education, he exemplifies how understanding the power of money can lead to financial independence. His journey began with small investments, and he has shared his insights on compounding in his books and seminars. Moreover, consider the story of a couple, Tom and Lisa, who sought financial freedom by educating themselves on investments. They started with a modest investment in an index fund, consistently adding to their portfolio. After 15 years, their investment grew due to compounding, giving them the freedom to retire early and travel the world. These personal stories highlight that anyone can succeed with the right mindset, discipline, and application of compounding principles. It's not about how much you start with, it's about the commitment to consistently contribute over time. In sharing these narratives, we can inspire a new generation to embrace financial education and smart investing. However, what strategies have these individuals used to achieve their goals? As we transition into the next chapter, let's uncover the actionable steps anyone can take to leverage the secrets of compound interest to their advantage. While the mathematics of compound interest is straightforward, the psychological factors that influence our financial decisions can be intricate and powerful. For many, investing is a terrifying leap into the unknown, filled with anxiety over market fluctuations, the fear of loss, or the unknown impact of time. But understanding the psychology behind investing can be your strongest ally in harnessing the power of compound interest. Take, for instance, the common phenomenon of loss aversion. Behavioral economists have discovered that individuals tend to feel the pain of a financial loss about twice as strongly as they feel the pleasure of a gain. This means that when the market dips, even temporarily, many investors panic and sell off their assets, locking in losses instead of riding out the volatility. Emotions can derail even the best strategies. Imagine you were invested in a diversified portfolio that would yield an average return of 8% per year, thanks to the compounding effect. But after a market downturn, your portfolio's value dips by 20%. Instead of staying the course, you decide to withdraw your investments to avoid further risk. In doing so, you not only realize that loss but prevent yourself from benefiting from the eventual recovery, which could lead to compound gains in the future. Moreover, there's the tendency to procrastinate, a common trend among young adults when it comes to investing. An eye-opening study by the Employee Benefit Research Institute found that nearly 60% of Americans were not invested in a retirement account at all. Many believe they'll start investing tomorrow or next year, unaware that every moment delayed is an opportunity lost to compound interest. To combat these psychological traps, experts suggest strategies such as setting automatic contributions to investment accounts, which can help bypass the emotional decision-making process. Another effective method is reframing your mindset. Rather than focusing on the immediate market volatility, remind yourself of the long-term trajectory of your investments. This mindset enables you to celebrate small gains and remain resilient in the face of losses. Moreover, building a community around your investing journey can bolster your confidence and keep you accountable. Whether it's through online forums, local investment groups, or social media, sharing your experiences and insights with others makes the process less daunting. As you navigate the complex landscape of investment, remember that understanding your own psychology is just as important as understanding financial principles. With discipline and a supportive network, you can unlock the true power of compound interest and transform your financial future. But can you resist the temptations of modern consumerism to prioritize investing over immediate gratification? When considering the true power of compound interest, one cannot overlook the significant impact of taxes on investment returns. Taxes can siphon away a considerable portion of your gains, making it crucial for investors to understand how to navigate this complex landscape. A well-structured tax strategy can enhance your compounding efforts significantly, allowing you to enjoy more of your returns in the long run. Let's start with the concept of capital gains tax. When you sell an asset like stocks or bonds, the profits you make are subject to capital gains tax, which varies based on how long you've held the asset. Short-term capital gains, typically for assets held less than a year, are taxed at ordinary income rates, which can be substantially higher than long-term capital gains rates. For example, consider a hypothetical investor who buys $10,000 worth of stocks and sells them for $15,000 after 6 months. If they fall into the 24% federal income tax bracket, they would owe $1,200 in taxes, drastically reducing their effective profit. On the other hand, if that investor held on to those stocks for over a year, they would pay a significantly lower capital gains tax rate, perhaps around 15%, resulting in taxes of only $750 on the same profit. This illustrates the importance of the investment horizon in optimizing your tax obligations and maximizing your compounding returns. Additionally, tax-advantaged accounts like IRAs and 401(k)s can further magnify the benefits of compound interest. Since contributions to these accounts may reduce your taxable income, and the investments grow tax-free or tax-deferred, you can potentially amass a fortune over time without the drag of annual taxation. For instance, consider a 30-year-old who contributes $6,000 annually to a Roth IRA. If this money grows at an average annual rate of 8%, by the time they reach 65, they would have over $1.4 million, all tax-free, simply because they utilized a tax-advantaged account. Alternatively, if they invested in a taxable account, their tax bill could significantly reduce their end amount, demonstrating the undeniable power of strategic tax planning in compounding wealth. Understanding the tax implications of your investments is not just an additional consideration, it's a crucial element of your overall strategy to maximize compounding interest. As we explore the intersection of taxation and investing, one question remains: are you prepared to leverage your knowledge of taxes to amplify your compounding efforts, or will you risk losing out on the benefits? Maximizing the benefits of compound interest doesn't just happen by chance. It requires intentional strategies and disciplined financial habits. Here, we'll delve into effective tactics that can position you for success in your wealth-building journey. First and foremost, make investing a habit. The easiest way to do this is through automatic contributions to your investment account. By setting a specific amount to be invested automatically each month, you ensure that you consistently save and invest, no matter how your emotions fluctuate. This pay-yourself-first strategy is critical for harnessing compounding. Secondly, diversify your investments. By spreading your investments across various asset classes, stocks, bonds, real estate, and even alternative assets, you can mitigate risks and capture more growth opportunities. A well-rounded portfolio can weather market fluctuations better than one heavily invested in a single asset class. Furthermore, diversification often leads to more consistent returns, which help accelerate the compounding process over time. Third, continually educate yourself about personal finance and investment strategies. Knowledge is a powerful tool in making informed decisions that can lead to better outcomes. Whether it's through reading books, attending seminars, or engaging with online courses, staying informed will empower you to adapt to changing market conditions and identify new opportunities for compounding wealth. Moreover, consider engaging with a financial advisor who can provide tailored guidance for your specific circumstances. A knowledgeable advisor can help optimize your investment strategy, suggest suitable asset allocations, and assist with tax strategies to further enhance compounding. Finally, stay the course during market volatility. The nature of investment means that you will face ups and downs. Resist the urge to sell and panic. Instead, remember that compound interest works best with time. The journey toward wealth through compound interest is a marathon, not a sprint. By integrating these strategies into your financial life, you can solidify your path toward financial independence. But will you take the necessary actions today to prepare for tomorrow's success? As we look ahead, the landscape of investing and the application of compound interest is evolving rapidly. With technological advancements and changing economic conditions, investors must adapt to stay ahead. Let's explore the future trends that will shape investing and the role of compound interest in the years to come. One major trend is the rise of robo-advisors. These automated platforms provide investment management services with minimal human intervention, often at a lower cost than traditional advisors. They utilize algorithms to create and manage a diversified portfolio tailored to an investor's risk tolerance and goals. This allows more individuals to access the benefits of compounding without needing extensive financial knowledge. Robo-advisors also emphasize investing in low-cost index funds, which aligns perfectly with the principles of compound interest by allowing investors to benefit from market growth over time. Furthermore, the growth of fractional investing enables individuals to invest in a piece of high-value assets, such as shares of expensive companies, rather than waiting to save enough to buy a whole share. This democratizes investment opportunities and encourages more people to start investing earlier, which is crucial for leveraging compound interest. Additionally, with the rise of cryptocurrency and blockchain technology, new investment vehicles are emerging. Some cryptocurrencies offer staking rewards, which can compound returns over time. While the volatility of crypto is well documented, those who understand and manage the risks may harness its potential for compounding wealth. However, investors should proceed with caution and thorough research before diving into this relatively uncharted territory. Moreover, environmental, social, and governance (ESG) investing is on the rise. Many investors are now prioritizing sustainable investments, which can provide solid returns while aligning with personal values. Research shows that socially responsible companies tend to outperform their counterparts over time, as consumers increasingly support businesses that contribute positively to society. This trend may lead to more people investing early and often, further enhancing the compounding effects of their investments. But amidst these changes, one timeless principle remains: the power of compound interest. Technology may simplify the process, but it still rests on the fundamental truth that the earlier you start investing and the more consistently you contribute, the more wealth you can accumulate over time. The question is, will you adapt to leverage these future trends in your journey toward financial success? As we draw this exploration of compound interest to a close, let's reflect on its lasting legacy. Beyond personal wealth accumulation, the principles of compound interest can shape generational wealth and societal change. The impact of understanding and applying these principles extends far beyond the individual, influencing families, communities, and future generations. Consider the generational wealth of families who have successfully passed down the knowledge of investing and the importance of compound interest. Wealthy families often instill financial literacy into their children from a young age, fostering a culture of saving and investing that allows their wealth to grow exponentially over time. These families take advantage of compound interest over generations, as their investment portfolios continue to grow with time, ultimately leading to financial independence for future descendants. In contrast, those without this knowledge or support might struggle to break free from the cycle of living paycheck to paycheck. Moreover, financial literacy plays a critical role in bridging economic gaps in society. By educating individuals about the power of compound interest and sound investing practices, we can empower more people to create wealth and secure their financial futures. Programs aimed at increasing financial literacy in underserved communities have shown promise in changing lives. For instance, initiatives like the Jump Dollar Tart Coalition provide students with the tools and resources needed to understand personal finance. Investing in education today means building a stronger, more financially literate society tomorrow. Ultimately, the legacy of compound interest isn't just about numbers, it's about the stories of those who changed their lives through informed financial decisions. As we part, remember that the power of compounding is within your reach. With every dollar you save and invest, you're not just putting money away, you're building a future filled with possibilities for yourself and those you love. So, will you choose to harness this power to change your legacy and the lives of those around you? When it comes to finance, few concepts are as powerful yet misunderstood as compound interest. Many people believe it to be a simple mathematical formula, but the truth is much richer and more complex. Let's dive into the common myths surrounding compound interest that often lead to missed opportunities and misguided beliefs. For instance, many assume that compound interest is only beneficial for those who are wealthy. In reality, it can revolutionize the financial futures of individuals from all walks of life, regardless of their starting point. But how does this work, exactly? One of the most prevalent misconceptions about compound interest is that it only applies to savings accounts or bonds. Many neglect its impact on investments like stocks or real estate, which can also yield impressive compounding returns over time. Consider the story of Jack, a college student who started investing just $100 a month into a diverse portfolio of stocks. He believed that he needed a large sum of money to make an impact. However, by the time he reached retirement age, his modest investments had grown exponentially, thanks to the compounding effect. According to historical data, an average annual return of 7% compounded can turn a $1,200 annual investment into over $1 million over 40 years. This starkly highlights that even small, consistent contributions can yield astonishing results over time. Many people mistakenly focus only on the interest rate without considering the impact of time. The earlier you start, the greater the potential for growth. In one case study, two brothers invested at different times. The first started at 25, while the second waited until 35. The first brother retired with over double the savings of the second, simply due to the earlier start. Another common myth is that you need to leave your money untouched for years to enjoy the benefits of compounding. While it's true that letting the compounding process run its course is beneficial, it doesn't mean you can't contribute regularly along the way. In fact, adding to your investments can significantly increase your overall returns. This is due to the fact that each new contribution also begins to compound. The psychological barrier many face is the fear of the unknown. People often hesitate to invest because they fear losing money. However, understanding compound interest can transform that fear into a motivator to take action. By illustrating how compound growth functions, we can help demystify the process. As we examine these misconceptions, we uncover the true potential of compound interest and how it can serve anyone willing to learn about it. In the following chapters, we will not only delve deeper into these truths but also explore strategies and real-life examples of those who capitalized on the power of compound interest. By debunking these myths, we can empower individuals to take control of their financial futures and realize that any amount of money can grow significantly over time. So, how can we shift our mindset to embrace the power of compound interest rather than fear it? Join us as we uncover the real stories of individuals who faced their misconceptions and took action, leading to remarkable financial transformations. Can you imagine what a change in perspective could do for your financial journey? Have you ever wondered why some investors seem to effortlessly grow their wealth, while others struggle? The answer often lies in their understanding and application of compound interest. Let's explore the strategies that wealthy individuals use to harness this financial phenomenon to their advantage. One key strategy is understanding the difference between simple interest and compound interest. Most people mistakenly believe that all interest is the same, but wealthy investors know how to make their money work harder through compounding. To illustrate this, think about two individuals. One invests in a savings account with simple interest, while the other invests in a mutual fund with compound interest. Over decades, the compounding investor will likely end up with a significantly larger sum due to the exponential growth that occurs. Additionally, wealthy investors tend to focus on reinvesting their earnings. Rather than taking profits or interest payments as cash, they reinvest them to maximize the compounding effect. Take the case of Sarah, who invested in real estate. Sarah consistently reinvested her rental income into purchasing more properties. Over time, her portfolio expanded, and she found herself not only earning income but also exponentially increasing her net worth through compound growth in property values. Another secret is diversification. Wealthy individuals often invest in a variety of assets that grow at different rates, creating multiple compounding streams. For example, they might diversify into stocks, bonds, real estate, and even business ventures. This not only mitigates risk but also allows them to tap into various compounding opportunities simultaneously. Moreover, they understand the importance of time and patience. Compound interest does not produce instant gratification, it takes years to truly see the fruits of your labor. Billionaire investor Warren Buffett often emphasizes the need for long-term thinking, stating that, "Time is the friend of the wonderful company." This mindset helps investors stay the course, even when the market experiences volatility. Let's take a closer look at the eighth wonder of the world, as Albert Einstein famously called it, compound interest. Consider the powerful example of how a small investment of just $5,000 in an S&P 500 index fund could grow to over $1 million over several decades due to compounding. If that same amount is reinvested continuously, the effect is mind-boggling. Wealthy investors capitalize on these possibilities by making informed decisions early on, and they continuously educate themselves about market trends and investment opportunities. Networking and mentorship also play a crucial role in their success. Wealthy individuals often surround themselves with advisors and mentors who have mastered the art of investing. By learning from others, and sharing insights, they expand their knowledge base and uncover new possibilities for compounding their wealth. Ultimately, the secrets of wealthy investors boil down to informed decision-making, patience, and a strategic approach to compound interest. They recognize that understanding and applying these principles can lead to financial freedom and the ability to build generational wealth. The key takeaway here is that with the right strategies, anyone can emulate the wealth-building journey of these savvy investors. As we continue exploring the transformative power of compound interest, we will dive into the final chapter, which focuses on how to create a lasting legacy through your financial decisions today. What will your financial legacy look like? Are you ready to harness the power of compound interest to shape it? What does it mean to leave a financial legacy? For many, it's about more than just money, it's about the values and lessons passed down through generations. Compound interest plays a pivotal role in shaping this legacy, allowing families to transform their financial destinies over time. Let's consider the Johnson family, who understood the importance of creating a financial legacy. They began investing in a diversified portfolio in the early 1990s. Over the years, they emphasized education around financial literacy and smart investing for their children. The parents made it a point to involve their kids in discussions about money, teaching them how to leverage compound interest for long-term wealth. As a result, when the children reached adulthood, they weren't just knowledgeable about finances, they were also prepared to make informed investment decisions. By the time the youngest child was ready to invest, their family's initial investment of $5,000 had grown to over $100,000 due to compounding. This substantial sum equipped the children with the capital needed for their own ventures, continuing the legacy of wise investing. In many cultures, there's a deep-rooted belief in the importance of passing down wealth responsibly. Research shows that families that practice financial literacy and investing principles have better outcomes concerning wealth retention and growth. For instance, a study from the Credit Suisse Research Institute indicates that educating heirs about investments significantly increases the likelihood of preserving wealth across generations. Moreover, setting up financial vehicles like trusts or custodial accounts can protect wealth and ensure it's managed wisely. These structures provide a framework for family wealth to be utilized effectively, with a focus on long-term growth through compound interest. Imagine a trust fund that continually reinvests its earnings. It can grow substantially over decades, creating a legacy that supports future generations. Another vital aspect of creating a lasting legacy is charitable giving, which wealthy families often incorporate into their financial strategies. Philanthropic endeavors not only provide tax benefits but also instill values of kindness and responsibility in younger generations. By teaching kids about the importance of giving back, families can use their wealth to make a positive impact, further solidifying their legacy. In the end, creating a financial legacy through compound interest requires intention, education, and thoughtful planning. It's about empowering future generations to understand and utilize the principles of investing so they can continue to build upon the foundation laid before them. As we reflect on this journey through the secrets of compound interest, remember that your financial decisions today will profoundly shape the legacy you leave behind. Will you take up the mantle and ensure your financial legacy thrives for generations to come? As we conclude, let's remember that the pursuit of financial knowledge, the effective use of compound interest, and the values we instill in our families can lead to a lasting impact, one that transcends wealth alone and fosters a culture of financial literacy and growth. In the realm of finance, one of the most sinister yet often overlooked enemies of your wealth is inflation. While compound interest has the power to multiply your savings, inflation can quietly erode the value of that wealth over time. Imagine this: you diligently save $10,000 in a high-yield savings account with a 5% interest rate, compounded annually. After just 5 years, you would have accumulated $12,762. But what if inflation averages 3% during that same period? Suddenly, those $12,762 are not worth as much as they seem. Inflation reduces purchasing power, meaning that the $12,762 you see in your account may only be equivalent to about $10,500 in today's dollars, not the robust gain you initially envisioned. To truly understand the relationship between compound interest and inflation, let's explore the concept of real returns. Real returns take into account the impact of inflation. For example, if your investment earns a nominal return of 5% but inflation stands at 3%, your real return is only 2%. This seems like a tiny difference, but over decades, it can make a significant difference in your total wealth. Case studies from various decades showcase this relationship. Let's look back to the 1970s and 80s, a period marked by soaring inflation rates. During this time, even those who were diligent savers found themselves struggling. If you had invested in stocks during this period, your gains might have seemed substantial, but when adjusted for inflation, many investors found that their purchasing power was stagnant. Let's delve deeper. Consider the following illustrative scenario: a young investor, Anna, starts contributing $200 a month to an investment account yielding a 7% return with compounding interest. Fast forward to 30 years later, Anna's account appears to have grown to over $200,000. However, if we factor in an average inflation rate of 3%, her purchasing power is only around $100,000 today. It's crucial for investors to not only chase high interest rates but also to be mindful of inflation trends. They should consider diversifying their investments to hedge against inflation, such as investing in real estate or commodities, both of which have historically been great buffers against inflation. Real estate, for example, often appreciates at a rate higher than inflation, making it a popular investment option. So how can you prepare for inflation while still benefiting from compound interest? A good strategy is to continuously educate yourself on economic trends and adjust your investment strategies accordingly. Being proactive can make the difference between losing your wealth or watching it thrive. As we reflect on these concepts, remember, compound interest can work wonders, but always keep an eye on inflation's eroding grip. Imagine finding a powerful strategy to combat inflation. In our next chapter, we'll unlock some of those vital strategies and discuss how to protect your wealth in a fluctuating economy. In finance, the journey to wealth is not solely about how much you start with, but how consistently you contribute over time. This principle is often overshadowed by the allure of high returns and miraculous overnight successes. However, the magic of compound interest truly shines when combined with regular contributions. Let's take a deep dive into the significance of regular contributions and their impact on wealth accumulation. Consider this: if you start investing $100 every month at a 6% annual return, after just 10 years, you would have invested a total of $12,000. But due to the power of compounding, your account could grow to over $15,000. That's a $3,000 gain simply from regularly contributing. Now, let's explore the power of time. For instance, Jake, a 25-year-old, decides to start investing $300 a month into a retirement account with a 7% return. By the time he is 65, he could potentially amass over $1 million. On the contrary, his friend Tom, who waits until he is 35 to start investing the same amount, would have only around $600,000 by age 65. The lesson here is clear: starting early and consistently contributing can yield substantial differences in the long run. But regular contributions can also act as a safeguard against market volatility. This tactic is known as dollar-cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. This strategy can smooth out the effects of volatility and help you accumulate wealth steadily over time. Moreover, there are psychological benefits to this approach as well. Making contributions automatic can help you avoid the temptation of pulling funds out or not investing at all during downturns. Automating your investments with a direct deposit from your paycheck can keep you on track and ensure you're harnessing the power of compounding. Let's look at a historical example. Employee retirement plans like 401(k)s encourage regular contributions by allowing employees to set aside a portion of their paycheck before taxes. The data shows that employees who participate in these plans average far greater savings by retirement compared to those who don't. In our next chapter, we will explore the crucial factors that contribute to the compounding effect, such as interest rates, time, and investment types. You won't want to miss how these elements interplay to shape your financial future. As we navigate through the modern world, technology is redefining how we manage our finances and engage with compound interest strategies. Today, anyone with a smartphone can harness sophisticated investment tools that were once only available to the ultra-wealthy. We live in an era where you can invest in global markets with a click of a button, making the power of compound interest more accessible than ever. Robo-advisors are one of the most remarkable innovations in this space. These algorithms create personalized investment strategies based on your risk tolerance and goals, automatically rebalancing your portfolio over time. Imagine you are using a robo-advisor like Betterment or Wealthfront, setting it up in just minutes without needing extensive financial knowledge. They work tirelessly in the background, making adjustments to ensure your investments continuously leverage compound interest effectively. Now let's discuss mobile investment applications, which empower users to start investing with as little as $1. Applications like Acorns, Stash, and Robinhood have democratized investing, allowing millennials and Gen Z to invest their spare change or buy fractional shares of stocks. This is revolutionary, as it enables anyone to start harnessing the benefits of compound interest, regardless of their financial starting point. Moreover, education has taken a digital leap forward. With platforms like YouTube and podcasts, financial literacy resources are now more widely available than ever. Individuals can learn about compound interest and investment strategies with just a few clicks. They can calculate how much money they need to invest monthly to achieve their financial goals, thanks to apps that offer compound interest calculators. Consider the example of a young couple, Emily and Mark, who, through an investing app, learn how compound interest works. They decide to invest $500 per month in a diversified portfolio. At a conservative 6% growth rate over 30 years, they could potentially see their investment balloon to nearly $1 million. On a broader scale, technology is also influencing how businesses manage their operational finances. Companies can now invest in growth projects and calculate the returns with compound interest principles that enable them to forecast future profits. These advancements signify a shift toward a future where financial literacy and investing are part of everyday life. As we close this chapter, think about how technology has already started to reshape your personal finance. Will it encourage you to start investing or revisit your strategies? In our next chapter, we'll conclude with actionable takeaways from all we've learned about compound interest and how to apply them to create a lasting financial legacy. When we think of investing and wealth accumulation, we often focus on the numbers, rates of return, investment strategies, and financial products. However, one often overlooked aspect of investing and the successful application of compound interest is the role of emotional intelligence. Emotional intelligence, or EQ, is the ability to understand and manage your own emotions, as well as the emotions of others. In the world of finance, this means being able to navigate the highs and lows of market fluctuations without letting fear or greed dictate your decisions. Let's consider a real-life example that illustrates this point. Imagine two investors, Jane and Tom. Jane has a high EQ, while Tom has a low EQ. They both invest in the same index fund. At first, both see their investments rise steadily. But when the market takes a downturn, Tom panics. He sees red numbers in his portfolio and decides to sell at a loss. Conversely, Jane understands that market fluctuations are normal, especially in the long-term investing landscape. She holds on, knowing that over time, the tide will turn. This difference in emotional response can significantly impact their financial outcomes. Research shows that investors with higher emotional intelligence are more likely to stick to their investment strategies and avoid the emotional traps that lead to poor financial decisions. In fact, a study published in the journal, Financial Analysts Journal, found that emotionally intelligent investors outperformed their counterparts by a staggering margin. They understood the power of compound interest and leveraged it through disciplined decision-making. Emotional intelligence encourages patience. Wealth building is not a sprint, it's a marathon. By cultivating an awareness of our emotional reactions to financial situations, we can better manage our investments and let compound interest work its magic. Another important aspect of emotional intelligence in finance is the ability to communicate effectively, especially for those who are investing in partnerships or within family units. Strong financial partnerships often rely on clear communication that minimizes misunderstandings and fosters a supportive environment for investment decisions. For example, when families invest together, the varying levels of financial knowledge can lead to conflict. A high EQ investor might navigate these discussions by facilitating open dialogues, addressing concerns, and understanding differing viewpoints, which in turn strengthens their collective investment approach. As we delve deeper into the significance of emotional intelligence within the investment space, it's crucial to remember that mastering your emotions is as important as mastering your portfolio. The narrative surrounding wealth building becomes richer and more rewarding when we blend financial acumen with emotional insight. This brings us to another compelling point: how the combination of emotional intelligence and compound interest can ultimately lead to generational wealth. Imagine passing on not only your assets but also the emotional literacy necessary to manage those assets wisely. By fostering open conversations about money, encouraging financial literacy, and teaching the principles of delayed gratification, you create a financial legacy that endures through the ages. So, as we unpack the secrets behind compound interest, let's also explore how emotional awareness can serve as the backbone of our financial strategies, ensuring that we harness the full potential of compounding in our investment journeys. In our next chapter, we will explore the intricate relationship between compound interest and financial education, emphasizing the importance of understanding these concepts for future generations. Investing isn't just a financial endeavor, it's a psychological one. Many investors fall prey to psychological traps that can severely undermine their ability to leverage the power of compound interest. One of the most prevalent traps is known as loss aversion. According to behavioral economists Daniel Kahneman and Amos Tversky, people tend to prefer avoiding losses rather than acquiring equivalent gains. This means that the pain of losing money feels more intense than the pleasure of gaining the same amount. As a result, when the market dips, many investors react impulsively, selling off their investments in an attempt to prevent further losses. Let's look at a case study. In the 2008 financial crisis, countless investors pulled their money out of the stock market at the worst possible time, locking in substantial losses. Those who had the fortitude to ride out the market's volatility, however, saw their portfolios rebound and benefit from compound interest in the subsequent years. Another psychological trap is overconfidence bias. Investors often overestimate their knowledge and ability to predict market movements. This can lead to high-risk strategies based on gut feelings rather than sound data. In a 2006 study by the Financial Services Authority, it was revealed that overconfident investors tend to trade more frequently, ultimately decreasing their returns due to higher transaction costs and poor decision-making. The compound interest principle illustrates why long-term, consistent investing often outperforms frequent trading. By allowing investments to grow over time, you harness the power of compounding rather than succumbing to the temptation of trying to time the market. Confirmation bias is another mental trap. Investors tend to favor information that confirms their existing beliefs, ignoring pertinent facts that might suggest a change in strategy is necessary. For instance, an investor who believes in a particular stock may overlook warning signs and continue to invest, potentially missing out on the compounding benefits if they shift strategies at the right time. One way to combat these psychological traps is to create a solid investment plan and stick to it. This plan should be based on thorough research, rather than emotional responses to market fluctuations. Regularly revisiting and adjusting this plan can help investors remain grounded in their strategy. Additionally, incorporating practices such as mindfulness can significantly improve decision-making. Being present and aware of one's emotional state can prevent irrational decisions based on temporary market dynamics. For example, during a market downturn, instead of panicking, a mindful investor might take time to reevaluate their goals, assess their risks, and remind themselves of the long-term benefits of compound interest. As we move forward, it's essential to recognize how our psychological tendencies influence our financial decisions and ultimately impact our wealth-building journey. By being aware of these traps and developing strategies to avoid them, we can better utilize the power of compound interest in our favor. Next up, we will explore how financial education can serve as a robust antidote to these biases, equipping us with the tools and knowledge required for strategic investing. Generational wealth is a term we hear often, yet its nuances often remain unexplored. What does it really mean to build wealth that lasts through generations? At its core, generational wealth is about passing on not just money, but financial knowledge. And one of the most influential concepts in creating generational wealth is compound interest. Picture a family that starts saving for their child's education the day they are born. If they set aside even a modest amount each month into a high-yield investment account, those contributions will compound over the years, creating a substantial nest egg by the time the child reaches college age. For instance, let's assume they invest $200 a month with an average annual return of 7%. By the time the child turns 18, they will have nearly $100,000 saved for their education, all thanks to the power of compound interest. But it doesn't stop there. Imagine if that same family continues to invest that money for their child's future. If the child becomes an adult and inherits that account, and they too continue to contribute, the wealth grows exponentially, compounding through the generations. Not only does this demonstrate the power of compound interest, but it also showcases the importance of financial literacy. Parents who educate their children about money management and investing are empowering them to maintain and grow that wealth. Let's take inspiration from the Rockefellers, one of America's most famous wealthy families. They established a family office to manage their wealth and have been successful in teaching successive generations about the value of investing and financial responsibility. Their approach emphasizes not just growing wealth but preserving it through smart investment strategies. Another fascinating example is the family of Barbara Corcoran, a prominent investor and entrepreneur. She has publicly shared how her parents instilled in her financial principles from a young age. Barbara has attributed her success partly to the lessons learned from her family, emphasizing that understanding the principles of investing, including compound interest, allowed her to build and maintain her wealth. Therefore, as we explore generational wealth, we must highlight the importance of not just accumulating wealth but also educating future generations on how to sustain it. It's also crucial to integrate discussions about financial literacy into the educational curriculum. Schools should teach children about saving, investing, and the benefits of compound interest. A well-rounded financial education will equip future generations with the tools they need to build and preserve wealth. As we conclude this exploration into generational wealth, consider this: the true legacy is not merely the riches you leave behind but the knowledge and values that come with it. Up next, we will delve into the role of community and social networks in wealth building, revealing how collaboration and shared knowledge can amplify the effects of compound interest. To fully grasp the secrets of compound interest, one must first understand the time value of money. This fundamental principle indicates that $1 today is worth more than $1 in the future. Why? Because money can earn interest, and over time, that interest can grow exponentially. The concept is simple yet profound, affecting every financial decision we make. To illustrate, let's consider two friends, Alice and Bob. Both friends are 25 years old and decide to start saving for retirement. Alice puts away $5,000 each year for the next 10 years, while Bob procrastinates and waits until he's 35 years old to start saving. He puts away $5,000 every year for 30 years. Assuming a modest average annual return of 7%, by the time they reach 65, Alice will have approximately $1.2 million saved, while Bob, despite contributing for 20 more years, will only have around $1 million. This stark difference illustrates the significant impact of the time value of money. The earlier you start, the longer your money has to grow.